There's a pattern in technology that repeats itself across generations. A new technology emerges. Everyone proclaims it will change everything. Investors pour in billions, sometimes trillions. Stock prices soar. Then reality arrives. The technology works, but not at the scale promised. Revenue fails to materialize. Companies that spent billions falter. Stock prices crash. Wealth evaporates. It happened with railroads in the 1800s. It happened with radio in the 1920s. It happened with .com in 2000. It happened with crypto in 2021. And right now, in 2025, it is happening with artificial intelligence. Not because AI is ineffective. AI works, but expectations are inflated, spending is astronomical, and the revenue model is unclear. The math does not add up. Let's begin with the scale of investment, because it is almost incomprehensible. In the last 2 years, companies have spent over $10 trillion globally on AI. In 2023, corporate spending on AI infrastructure alone, data centers, chips, electricity, cooling, maintenance, was approximately $200 billion. In 2024, that figure jumped to $350 billion, so projections for 2025 exceed $400 billion. That is nearly $1 trillion on infrastructure alone in 3 years, excluding research, acquisitions, AI engineers, and software development. Who benefits from this spending? NVIDIA sits at the epicenter. Its GPUs, H100, H200, power nearly every advanced AI model in the world. NVIDIA's revenue from data centers exploded from $15 billion in 2022 to $47 billion in 2023, and projections for 2024 exceed $100 billion. Their revenue has increased sevenfold in 2 years, almost entirely due to AI. A single AI training cluster can cost $500 million to $1 billion. Microsoft has invested over $60 billion on AI infrastructure, including $13 billion directly in OpenAI and the remainder on building data centers and cloud capacity. Google spent $50 billion on its AI systems, developing TPUs and buying GPUs. Meta spent $40 billion, Amazon $30 billion. Collectively, the big five of AI, Microsoft, Google, Meta, Amazon, NVIDIA, have spent over $300 billion in just 2 years. Yet revenue does not match the scale of investment. OpenAI, creator of ChatGPT, has annual revenue of about $3.5 billion as of late 2024, up from $1 billion in 2023. Impressive growth, but still unprofitable. Compute costs alone exceed $5 billion annually. Microsoft's AI products, Copilot, Azure AI, Bing AI, contribute perhaps $10 to $15 billion annually, but the company has spent $60 billion in infrastructure, meaning 4 to 6 years to break even under ideal assumptions. Google's AI revenue, primarily from cloud services and AI-enhanced search, is $15 to $20 billion annually, against $50 billion spent. Gemini, Google's AI product, is mostly free, a defensive strategy rather than a revenue generator. Meta and Amazon face similar dilemmas. Billions spent, new AI products generating minimal standalone revenue. Across all five, $300 billion in spending yields perhaps $60 to $80 billion in revenue, much of which comes from existing business lines enhanced by AI, not from entirely new AI-driven income. The new products, the consumer-facing chatbots, image generators, and assistants, contribute maybe $10 to $15 billion total. The ratio of spending to new revenue is roughly 20 to 1. 20 years of revenue would be needed just to break even, assuming growth continues and costs do not rise. A highly unrealistic assumption. The use cases for AI, while impressive, are limited when it comes to monetization. ChatGPT Plus costs $20 per month, Microsoft Copilot $30, Google AI Premium $20. ChatGPT has roughly 10 million paying subscribers, generating $2.4 billion per year. Enterprise revenue brings the total to $3.5 billion. Even at this scale, compute costs create a $2 billion annual loss. Microsoft Copilot has fewer than 5 million paying users. Google AI Premium, fewer than 2 million. Enterprise adoption is slow and expensive. Integrating AI into existing systems requires massive labor, extensive training, and capital-intensive infrastructure. Productivity gains are real but modest. MIT found GitHub Copilot improves programmer efficiency by about 26%, significant but not transformative relative to infrastructure costs. The costs of AI extend far beyond acquisition. Training a large language model like GPT-4 costs over $100 million in compute alone. Running inference, processing user queries, costs 1 to 4 cents per query. ChatGPT handles billions of queries per month, totaling $1.2 to $5 billion annually in inference costs alone. Energy consumption is staggering. Training GPT-4 consumed approximately 50 GWh of electricity, enough to power 5,000 American homes for a year. NVIDIA H100 chips draw 700 watts each. A cluster of 10,000 chips consumes $7 million continuously. Companies are building clusters of 50,000 to 100,000 chips, drawing 3570 memdollars continuously, costing $5,100 million per year in electricity, plus 30–50% more for cooling. AI data centers could consume more electricity than entire countries like Argentina or Sweden by 2027. The stock market makes the bubble visible. NVIDIA's stock surged from $150 in early 2023 to over $900 by late 2024. Market capitalization exceeds $3 trillion. Price-to-earnings ratio 65. Historically, a PE over 25 is considered expensive. Over 50 is bubble territory. Any slowdown in AI spending could trigger a collapse. Microsoft, Google, Meta, Amazon, diversified yet vulnerable, will take hits in AI write-offs. AI startups face existential risk. Burn rates are unsustainable. Consider Inflection AI, founded by DeepMind co-founder Mustafa Suleyman. The company raised $1.3 billion, built a chatbot called Pi. It works, users like it, but nobody pays for it. Microsoft acqui-hired the team in 2024 for $650 million, absorbing the technology and personnel. Inflection's investors recouped only a fraction of the original capital. Compute, talent, infrastructure, $500 million spent. Revenue minimal. This is the pattern. Billions raised, billions spent. No path to profitability, eventual consolidation or failure. The parallels with the dot-com bubble are unmistakable. In 1999, internet stocks exploded. Pets.com, Webvan, eToys, companies with hype, users, but no profits. NASDAQ hit 5,000 in March 2000, then collapsed to 100 by October 2002. 78% decline. $3 trillion in market value disappeared. Survivors, Amazon, Google, eBay, had real business models, revenue, paths to profitability. The rest vanished. AI in 2024 mirrors 1999, technology real, hype massive, valuations inflated, revenue insufficient. Companies are spending tens of billions in anticipation of markets that may never materialize. Now let's break down the current financial reality for AI companies in granular detail. OpenAI, for instance, has $3.5 billion in annual revenue, but spends over $5 billion on compute alone. That's before salaries, rent, software, and other operational costs. Microsoft invested $60 billion into AI infrastructure. If their AI revenue truly is $10 or $15 billion annually, it will take 4 to 6 years just to break even, assuming revenue does not decline and costs do not increase. Google's $50 billion investment into AI infrastructure faces similar math. Gemini, their AI product, is free for most users, meaning billions are being spent without immediate revenue to offset the costs. Meta, Amazon, and other players follow the same pattern. The Big Five have collectively spent over $300 billion in just 2 years, generating at most $60–80 billion in revenue. That's a 20-to-1 ratio of spending to revenue. It's unsustainable. Enterprise adoption, while touted as a major revenue driver, is slower and more complex than hype suggests. Implementing AI at scale requires integrating new models into existing systems, training employees, ensuring compliance with privacy laws, and maintaining infrastructure. Productivity gains exist, but incremental. MIT research on GitHub Copilot shows a 26% increase in programmer efficiency. That's meaningful, but it doesn't justify multi-billion-dollar infrastructure outlays. Marginal revenue from enterprise AI is insufficient to absorb the vast expenditures. Consumer AI subscriptions are similarly constrained. ChatGPT Plus has roughly 10 million subscribers at $20 per month, generating $2.4 billion annually. Microsoft Copilot fewer than 5 million users. Google AI Premium fewer than 2 million. Even with enterprise clients, the revenue falls far short of the investment. Growth has plateaued. The early surge of new users has ended. The market for AI products is finite. Most companies and consumers adopt only a single solution. Once they have one capable AI assistant, they have no need for multiple alternatives. Market consolidation around one or two dominant players is inevitable, leaving the majority of AI startups stranded without revenue. The cost structure guarantees a vicious cycle. Large language models are expensive to train and run. GPT-4 cost over $100 million for initial training. Each query costs 1 to 4 cents in compute. Multiply by billions of queries per month. Power consumption is enormous. A single NVIDIA H100 draws 700 watts. A cluster of 50,000 to 100,000 chips consumes 35 to 70 MWh continuously. Electrical costs run $50–100 million per year for a single facility, excluding cooling. Multiple facilities amplify these costs into the hundreds of millions annually. Models only get bigger and more complex over time. GPT-5, whenever released, will cost more to train and operate than GPT-4. Efficiency gains from hardware improvements are insufficient to offset exponential increases in scale and model size. Energy consumption isn't just expensive, it's an emerging crisis. AI data centers could soon consume more electricity than entire countries. Training GPT-4 alone required 50 GWh, enough to power 5,000 US homes for a year. By 2027, AI infrastructure could rival national grids in energy demand. This is unsustainable. Power grids cannot scale at this pace. Environmental impact is massive and largely ignored amid the hype. NVIDIA's stock is a microcosm of the bubble. It rose from $150 in early 2023 to over $900 in late 2024, a six-fold increase. Market capitalization exceeds $3 trillion. Investors are pricing perfection into the stock. Price-to-earnings ratio, 65. Any slowdown in AI spending threatens a dramatic correction. Microsoft, Google, Meta, Amazon, while diversified, will still face massive AI write-offs. AI startups are most at risk. Burn rates are unsustainable. Without additional funding, tens of billions will vanish. Let's examine the mechanics of the bubble and why it will inevitably pop. History offers a guide. Bubbles collapse through three primary triggers. First, a major company fails. Lehman Brothers in 2008, Pets.com in 2000. A high-profile failure reveals the illusion, sparking panic. In AI, this could be a startup burning through billions and shutting down, or a major tech company writing off tens of billions in AI investments. Second, revenue growth stalls. Investors notice that promised returns aren't materializing. Crypto crashed in 2022 for this reason. AI will follow the same trajectory. ChatGPT subscriber growth plateaus. Microsoft Copilot revenue misses projections. Google admits Gemini isn't generating significant new income. Third, costs become unsustainable. Companies cannot maintain spending. Cuts follow. AI clusters stop expanding. NVIDIA chip sales decline. Layoffs accelerate. Reduced spending triggers further contraction. A doom loop. Inflection AI illustrates the pattern. Raised $1.3 billion, built a functional chatbot, but no paying market exists. Microsoft acqui-hires the team, for $650 million. Investors recoup less than half. Infrastructure and compute costs exceed $500 million. Revenue minimal. The life cycle is clear. Massive funding, infrastructure spend, minimal revenue, consolidation or failure. This repeats across the sector. Hundreds of AI startups built on hype rather than profit face extinction. Comparing to the dot-com bubble, parallels are stark. Internet companies in 1999 had users, hype, and valuations, but no profits. NASDAQ peaked at 5,000, collapsed to 1,100 by 2002, a 78% loss. $3 trillion vanished. Survivors had real revenue models. The rest disappeared. AI mirrors this. Technology works, hype inflates expectations, valuations soar, and the revenue reality is insufficient. Only a handful of companies will survive. Diversified giants like Microsoft, Google, Amazon, and the few startups with clear revenue paths like OpenAI or Anthropic, if they achieve profitability. Timing the AI bubble's peak is difficult, but indicators are emerging. Late 2024, some AI startups began running out of money. Investors ask difficult questions. What is your revenue? When do you break even? Many cannot answer. Spending continues, but the pace slows. Growth projections reduce. In 2025, AI spending still rises, but perhaps only 20% year over year instead of 50%. Investors perceive disappointment. Stock prices begin to decline. By mid-2026, companies report AI revenue failing to meet expectations. NVIDIA, most dependent on continued AI spending, experiences a 50-70% drop from peak $900 to $300 or less, erasing roughly $2 trillion in market capitalization. Big tech, Microsoft, Google, Meta, Amazon experienced 20 to 40% declines, largely in AI divisions. AI startups collapse en masse. 90% fail. Billions of venture capital vanish. Employees are laid off. The market consolidates around survivors with real revenue and sustainable models. The eventual stabilization phase occurs over 3 to 4 years. By 2028-2029, the AI sector reaches equilibrium. Survivors have sustainable businesses. Revenue grows steadily. Profitability exists. Technology integrates into society, infrastructure level, like cloud computing or the internet itself. The total market value is a fraction of the previous hype, perhaps $2 trillion instead of $10 trillion. $8 trillion of investment evaporates, consistent with historical tech bubble patterns. Even accounting for potential counterarguments, the pattern remains clear. Some argue AI will find new revenue streams, that enterprise adoption will accelerate, that consumer demand will explode. But these scenarios fail under scrutiny. The market for AI is finite. Once one capable model exists, there is no need for multiple redundant solutions. Enterprises do not require dozens of bespoke AI systems. Integration with existing infrastructure suffices. Services revenue scales poorly. Each enterprise implementation requires custom work, human labor, and ongoing support. Revenue cannot expand exponentially. Proponents suggest costs will fall. Moore's law predicts cheaper compute. Hardware efficiency improves. Chips get better. True, NVIDIA Blackwell chips are more efficient than predecessors, but they also cost more. The net cost reduction per query is only 20-30%. Meanwhile, models grow larger and more complex. GPT-5 will require more compute than GPT-4, even with superior chips. Efficiency gains are swallowed by increased model scale. Infrastructure costs remain astronomical. AGI, artificial general intelligence, is often cited as a transformative catalyst. A machine capable of all human intellectual tasks could, in theory, create vast revenue potential. Labor costs vanish, knowledge work automates, trillions in productivity unlocked. Yet two problems persist. First, AGI does not exist. Current AI is narrow, task-specific, unable to reason, plan, or understand complex context. Estimates for AGI range from 10 to 50 years, uncertain at best. Second, economic implications are paradoxical. Replacing human workers reduces the consumer base, contracting the very market that could pay for AGI services. Unlimited capability does not guarantee unlimited revenue. It could induce systemic economic contraction. For investors, the implications are immediate. Exposure to AI stocks carries high risk. Nvidia above $700 is vulnerable. Taking profits is prudent. Diversified tech companies are safer, but not immune. Expected 20 to 40% decline in valuations, concentrated in AI divisions. Venture investments in AI startups are effectively lottery tickets. 90% risk failure. Only allocate capital you can afford to lose entirely. Diversification is critical. Timing the peak is impossible. Gradual risk reduction and profit taking is the most rational strategy. Historical patterns predict the trajectory. First, hype inflates investment and valuations. Second, reality fails to meet expectations. Revenue falls short. Costs remain high. Third, a cascade triggers. Major stock corrections, write-offs, startup failures. Consolidation occurs. The survivors rebuild on realistic foundations. In technology bubbles, the underlying innovation survives. The inflated valuations do not. The excess capital evaporates, leaving a sustainable ecosystem. By 2027, AI spending contracts. Nvidia's stock declines sharply. Big tech reports disappointing AI revenue. AI startups fail or get acquired at fractions of their valuations. By 2028-2029, equilibrium returns. AI is ubiquitous but normalized, essential infrastructure, not headline-grabbing hype. Market capitalization reflects utility, not speculation. The $10 trillion invested between 2023-2025 produces only $2 trillion of enduring market value. The remaining $8 trillion dissipates, consistent with prior tech bubble collapses. Here's the critical takeaway. AI is real. It works. It is transformative in limited domains. But the expectations, investments, and valuations are 10 times larger than the market can support. History repeats, the bubble inflates, the market recalibrates, and only the most robust companies survive. The crash is inevitable. The question is whether investors recognize it in time or are caught in the collapse. Reality will always outpace hype. The final stage is consolidation and reflection. Once the bubble bursts, AI becomes infrastructure-level technology. It underpins productivity tools, cloud computing, enterprise workflows, and consumer applications. But it loses its narrative of immediate, limitless wealth creation. Early adopters who overpaid for infrastructure or stock valuations suffer massive losses. Billions evaporate. Venture funds report devastating write-offs. Employees are laid off. Startups disappear. This is not failure of technology. It is the natural consequence of speculative excess. By 2029, survivors operate sustainably. OpenAI, if profitable, integrates AI into enterprise solutions efficiently. Microsoft, Google, Amazon leverage their diversified ecosystems. AI functions as a utility, indispensable, integrated, but no longer headline news. Investors focus on real revenue streams, margins, and operational efficiency. The frenzy of the prior 6 years, the $10 trillion splurge, the six-fold growth in Nvidia stock, the $300+ billion in infrastructure spending, resolves into reality, a smaller, more efficient, and more profitable market. Lessons are clear. Technology bubbles follow predictable patterns: initial euphoria, overinvestment, reality check, collapse, consolidation, normalization. AI fits this pattern perfectly. The technology is real, revolutionary in parts, but the market is finite. Spending vastly exceeds returns. Infrastructure and operational costs dwarf revenue. Consumer adoption plateaus. Enterprise uptake is incremental, not exponential. Expectations meet reality, and the result is a sharp recalibration. The AI bubble, like the railroads of the 1800s, the radio of the 1920s, the dot-com bubble of 2000, and crypto in 2021, follows the same blueprint. Investors pour money into excitement, valuations skyrocket, reality lags, and the market corrects violently. A small number of firms survive and thrive, building sustainable businesses. The rest collapse, and trillions vanish. Here's what should terrify you. The pattern is already in motion. Companies are spending billions annually without clear revenue paths. Growth is slowing. Costs are staggering. Energy consumption is unsustainable. Stock valuations assume perfection. History says it won't happen. Reality will intervene. AI will remain. It will integrate into every industry. But the era of massive speculation, sky-high valuations, and runaway infrastructure spending will end in a crash. When it does, the survivors will inherit a normalized, profitable ecosystem. The hype will be gone. The math will matter again. And for those who recognize the pattern, the collapse will present opportunities to invest in sustainable, revenue-generating companies at realistic valuations. Maybe some investors believe AI is different. Maybe this time, the technology will generate returns that justify every dollar spent. But the pattern says otherwise. The math says otherwise. History says we're next. The AI bubble is real. It is here. And the only question is whether you will recognize it before the reality hits.